Well, I think the message is finally getting out there. The Reserve Bank is not inclined to touch that rate lever. Interest rates are on hold pretty much for the foreseeable future, which probably takes us now into the next year, into 2015. Once again, the Reserve Bank came out on Tuesday with its decision, and the words it used to explain its interest rate decision were exactly unchanged from all the previous announcements this year. Interest rates are on hold. The Reserve Bank, read my lips, is not inclined to touch those rates. They are locked. The following day, we got a sense that they are Goldilocks, that we have an economy which is not too hot, not too cold. Not too hot, otherwise the Reserve Bank would have to think about raising rates. Not too cold, otherwise the Reserve Bank would have to think about cutting rates. The economy is ticking over reasonably nicely. We got very strong growth figures for the March quarter. The reason we got very strong growth figures for the March quarter, though, was very narrowly focused. We had a surge in export income, thanks to that huge increase in iron ore exports. Maybe that won't be sustained. Maybe we won't keep getting increases in iron ore exports going forward. We may, in fact, get cuts in the levels of exports as the China economy loses some steam. We may even see, as we're seeing now, a further fall in the iron ore price. So given that reality, China is the fundamental determinant of when and if the Reserve Bank moves rates. If China slows sharply, obviously that would open the door to a rate cut sometime in 2015. If China regains its magic, if the China boom restarts, combined with a pickup in the US economy, you could eventually see us moving to rate hikes. But for the moment, rates are on hold. The Reserve Bank doesn't even have to be concerned about the property market, i.e. in the sense of the property market taking off, will continue to take off. We're seeing that property prices are levelling off. So the Reserve Bank would be a bit concerned about boosting activity in the property market by cutting rates. It would even be concerned about boosting activity, demand for property, demand for home lending by leaving rates unchanged. That's not a problem. So rates are not only locked, they are Goldilocks because the economy is broadly not too hot, not too cold. The big corporate news of the moment obviously is Westfield, this huge merger proposal to merge the Westfield Retail Trust, which only owns interests in all the Westfield shopping centres around the country, with the almost exactly the same assets which currently reside within Westfield Group, the company which has also got a development and has also got international exposure. Westfield Group wants to separate its property assets in Australia from that international dynamic. It's very important for Westfield Group to get a much cleaner focus and to get a much more high growth focus in that international space, and wants to merge the two sets of property assets in Australia into a mega shopping centre owner. It makes sense to do that, obviously, but the question is one of price. At what price you do that merger? Narrowly, the merger looks attractive for Westfield retail shareholders to tick off on. However, you really need to look at it in a much broader context. We're talking about absolutely prime assets, and we saw with the takeover proposal for Australand, another property bank, that Australian property really is at a premium. So there is no point at all, there's no justification at all for Westfield Retail to give up their very, very attractive property ownership asset in order simply to get bigger by absorbing Westfield, the other Westfield retail assets. Obviously, at the moment, the proposal is rejected. We didn't actually see a vote at the meeting a week ago, but it was clear that the proposal was going to go down. With nearly 75% of security holders wanting it, but you needed 75% plus one, the question is now going to be whether in the next 2 weeks before the next meeting, some of those retail investors in the retail trust will change their mind, or indeed whether Westfield can persuade enough of the people who didn't vote to come out and vote, cast their ballot in favour of the merger. It's very much a toss-up, and it's going to be a very interesting process to get to that final meeting. Finally, the market. Everywhere records are being broken. Wall Street hit a new record, a new all-time record. It hasn't just simply got back to the level reached before the GFC. It's back at an all-time record. The German DAX went through 10,000 for the first time ever overnight Thursday. It came back a little bit after that. The global markets everywhere are setting records except the Aussie market. In fact, the Aussie market actually went backwards over the week. It was down around 0.5% over the week after a fairly strong showing on Friday. It would have been down 1% over the week but for that Friday kickback, thanks to that very strong overnight performance in Europe and the US. What's the explanation for this? Well, I think in a sense we're being held back by our very success, because the Australian market is built essentially on the 4 big banks, the 2 big miners, and the 2 big retailers, Wesfarmers and Woolworths. All of those, the 2 retailers and the 4 big banks continue to power to record highs. The miners are hit by the fall in the commodity prices. But the very strength of, the very dominance of those 6 stocks, the 4 big banks and the 2 retail stocks, means they have to keep going to ever higher levels simply for the overall market to make ground, which is a very, very big ask and a very, very big imposition on their strengths. I mean, I would suggest that the Australian banks are already priced for perfection. To expect them to go to even higher heights is ambitious at best. So the overall market is going to struggle to go higher, despite the fact that the trend and the underlying mood in global markets is very, very optimistic. We really do have some major headwinds.